This is the gentleman from California, Mr. Miller, for 5 minutes.
Thank you, Mr. Chairman. I keep hearing from investors that they believe we need a vibrant TBA market for the housing finance system. Mr. Deutsch, what changes would you need to be made in this bill to ensure a vibrant TBA market would occur?
Currently, the TBA market functions because there is a government guarantee. If you go and you try to take out a mortgage and you want to rate lock it on a go-forward basis, the originator of that mortgage knows that they can sell it. They've got a government guarantee behind it. So fundamentally, what this bill tries to do is evolve that system from being a government guarantee that is a backstop to ultimately the capital markets evolving in some fashion through the utility, through other methods, to where the capital markets will effectively provide that insurance, if you will, in that you want, as a borrower, to be insured that from the time that you ask for the mortgage until the time you take out the mortgage, that rate doesn't change over time. So I think in virtually any other financial product, there is always a price that the capital markets will be willing to charge and ultimately offer that product to you to be able to rate lock over time.
If we end the guarantee, will investors continue to buy mortgage-backed securities in the market?
If you end the guarantee,
yes,
it will
continue to invest.
Absolutely, but it will, and it does require a shift. And I think the first panel, hit on it a few different points. Is that currently you have a significant amount of rates investors out there, but you need to shift some of those, and not all of them will shift. There will be many investors who are rate investors who won't magically turn into overnight into credit investors. But there will be some who will shift some of their product from buying rates products to credit risk products. But ultimately, and I indicated this in my oral and written testimony, we've got to start rebuilding that credit risk base to be able to get more investors to buy those credit risk products.
Okay, a question for the panel. Would it be more appropriate to avoid shocks in the market to tie the wind down of the GSEs to the ramp up of the utility with evidence-based market and structural triggers and milestones? Mr. Stevens.
Yeah, Congressman, I think that this is the question that's been debated a lot today is, can there be a TBA market without a guarantee? And I think what Tom alluded to is if the counterparty ultimately isn't backstopped by the U.S. government, which backs the mortgage-backed security, even if the originator fails and can't back up their representations and warranties themselves, it brings a lot of investment capital from around the globe, because then all the investor has to worry about is the interest rate risk. They know what they're buying from a homogenized product standpoint because it's defined, but what they don't know is whether the counterparty will be there to back up that loan, and having that wrap on it has created that capital flow. And so I think there's an opportunity as a pilot to determine whether you really can create a TBA market without the backstop, rather than completely pulling out the supports without knowing yet whether that system will work. And given the size and scope of it, which has been discussed today, I think doing this in a measured way is far more critical to making sure the system could support any shift to that kind of structure.
That seems to be what I'm hearing from a lot of sources. Mr. Howard, would you agree with that?
I would agree with that, Mr. Miller, and I would suggest that there might be a TBA market without a government guarantee, but I think it would be very, very expensive, and it would force a lot of people out of the housing markets.
So you think a wind down tied to a ramp up for verification would be most appropriate?
Yes, sir.
Mr. Calhoun.
A real additional concern is the TBA market, even if it does exist, is it available to all lenders based on size at comparable prices? I mean, it's a lot easier for an investor to evaluate what the counterparty risk is for Wells Fargo than it is for the local community bank. So the real questions are, you might, even if you've got a TBA market, which is uncertain, it might be available just for the largest lenders, which we think has adverse consequences. And if it's available even at all for the smaller lenders, there's almost certainly a tremendous price penalty that they have to pay.
And I don't believe any of us want to see another countrywide machine who sold these mortgage-backed securities that couldn't be unwound. They couldn't replace the bad mortgages. Investors were just stuck with them. That's why it left a lot of bad taste in a lot of investors' mouths today. And I think you, Mr. Deutsch, have a lot of people who realize that. They thought they were buying mortgage-backed securities from a GSE, and they weren't, and they lost tremendous amounts of money. I yield back to balance my time.
Gentleman yields back. The chair now recognizes